This segment discusses the statement of retained earnings. Retained earnings, remember, is the cumulative amount of reported net income, less any net losses and dividends declared since the company started operating. Here we are seeing a statement of retained earnings for ABC, which shows the change in retained earnings from the beginning of 2019 to the end of 2019. Started the year with $875 in retained earnings. Net income during the year increased retained earnings. They declared cash dividends of $80,000, leaving them with ending retained earnings of $950,600. There are times when there are restrictions on retained earnings. Sometimes they are legal restrictions. Most states will restrict the amount of Treasury stock purchases allowed to the amount of retained earnings. A company cannot purchase Treasury stock exceeding the balance in their retained earnings. There also might be contractual restrictions on retained earnings. Loan agreements can include restrictions on paying dividends beyond a certain amount of retained earnings. This is a fail-safe for creditors because they don't want a corporation to pay out all of their accumulated profits in dividends in the event they go out of business and liquidate, leaving nothing to pay creditors. A corporation's directors can also voluntarily limit dividends because of special needs for cash, such as the purchase of new facilities. In order to voluntarily restrict dividends, they will appropriate some of their retained earnings. So if ABC had $950,600 of retained earnings and management wanted to restrict $450,000 for the anticipated purchase of new facilities, they would appropriate it. Total retained earnings is not changed. $450,000 of it is now appropriated, leaving unrestricted retained earnings in the amount of $500,600. There are also situations where prior period adjustments are made to the general ledger, and those adjustments impact retained earnings. For example, correction of material or large errors in past year's financial statements. If an amount is incorrectly expensed in prior years, depending on the error, the amount could either be added or subtracted from retained earnings. So here we're seeing that for ABC, they had a prior period adjustment for the cost of equipment that was incorrectly expensed. The impact of that error, net of taxes, was a $72,000 increase to prior period income. Thus, it is showing here as an increase to retained earnings. Again, this is a detail that, or a concept that is beyond the scope of an introductory level accounting course. It is more of an intermediate accounting concept. However, it is being introduced to you here so you're aware of why there might be a prior period adjustment reflected in a corporation's statement of retained earnings. When you look at a corporation's financial reports, you may see an even more detailed version of a company's statement of retained earnings, and it is called the Statement of Stockholders' Equity. And this statement is more inclusive than just reporting retained earnings. This statement includes information about paid-in capital in addition to retained earnings. Here we are seeing for ABC Company the number of shares of stock that has been issued, along with sales and purchases at par and the retained earnings to bring us to total stockholders' equity.